Alright, what's up everyone? Welcome to another video. This video is going to be a quick market update. We're going to go over all the macro indicators, all the ticker symbols that follow the macroeconomic environment so we can get a good picture of what's going on. First thing we should talk about is the S&P 500. We are in a short-term downtrend as well as the long-term downtrend. We made new 52-week lows last week. We dipped below the previous 52-week lows, but this week we're having a nice bounce, a historic 3-day rally. We haven't had a rally this hard in 3 days since the crash of the pandemic around this area. And this big rally, well, this 2-day rally, 3-day rally is coinciding with a bounce off of previous highs here. And a bounce off previous highs is a technical support or resistance level where previous highs or previous lows are found. So the beginning of this quarter is starting off bullish. Let's see how far we can go with this bullishness. Let me zoom in. Here we are on the daily candles. Here's that previous high I mentioned from the past that we got that nice bounce from. But here is the current short-term trend. We are in this price channel, and it looks like the price wants to break out of the price channel. It hasn't done it yet. It's actually struggling to get above this long-term Fibonacci level I've had mapped out for quite some time. Now, the only reason that this bounce happened was because on Monday, we had some weak economic data pertaining to inflation. It showed that inflation was slowing, so the market got a little bullish, as if they were assuming the Fed might not hike rates as much. But that brings me to the next picture. Let's check out the Treasury yields. Now, here are 2-year yields. They've been breaking out in a big way. Recently, they have been on a slight consolidation downtick. It looks like that's probably contributing to the bullishness in the markets. But remember, the Fed has forecasted a 4.6 target for at least third quarter next year. And right now, 2-year yields are nowhere near that target at all. So there is more upside in 2-year yields and 10-year yields if you like to follow the 10-year, but the 2-year yields is what the Fed controls. They can't control the further out interest rates. So this is the one to watch if you want to see what the market's anticipating the Fed to do. And here we are flipped over to the 10-year yields, and the picture looks very similar, but this one has even more room for upside to get to the Fed's target by the third quarter of next year. Of course, if we get more economic data showing that economy growth is slowing or inflation is slowing, then we will see these numbers come down. But the Fed said we will need an obvious reversal in inflation. They want to see obvious data of an obvious downturn in inflation before they even consider stopping this quantitative tightening. And we don't have an obvious signal yet, so we should still technically be bullish on treasury yields and bearish on the market, in my opinion. It's a very similar story for the dollar index. That's another major macro indicator you can follow to get a good idea of what the markets might be doing. And of course, it rejected resistance on Q and headed downward. We got some good economic data, like I said. And this downtick also contributed to the slight bullishness that we had in equities, because if you know, the dollar index inverse correlation with equities. When the US dollar is going down, the market's generally going up. We did get a solid bounce in the dollar today, interestingly close enough to this previous support or resistance zone I've got highlighted here. I can see a little more downside before we get to some strong dynamic upward trending supports. I like to use those a lot, especially with rallying markets. As you can see, it's been following these quite well. So I could possibly see just a tiny bit more downside before we get a bounce in the dollar. And the dollar's rallying, the macroeconomic environment is not good, so the dollar's a good safe haven, and when the Fed's talking about increasing interest rates even more, we're going to see more upside in the dollar, theoretically. But we are near some very long-term historical resistance zones. I'm going to make another video about the dollar index to point out a little more detail on that, so keep an eye on these high levels of around 113 to 116 levels. But I'll post another video very soon about that. But remember, if the market thinks interest rates are going up, then we'll see a little bit more upside in the dollar, theoretically. Now, let's quickly go over corporate credit. This is ticker symbol LQD. That stands for liquid. I'm assuming these are liquid companies. who have very good credit. And if you invest in corporate credit or you follow corporate credit, then you know people that invest in corporate credit assume they're going to get their money back in the future. So when the future looks bad for the economy, then they're going to be selling off, just like we've been seeing in corporate credit for quite some time. And this is the current trend that you can see here. It's to the downside. It looked like the price wanted to break out of this price channel, but it did return to the price channel. So let's see what happens here. If we do break out to the upside, that would look bullish for equities, on the short term at least. Now here's the ticker symbol HYG. This is less liquid companies. These companies are less likely to survive an economic collapse of some sort. These will typically be smaller companies with less cash, make less revenues, and it's also in a downward price channel. It broke out of the major price channel. It's reaching resistance where it previously tried to break out from, but it quickly came back down. We'll see if that happens again. If we do see upside out of this downward trending channel here, that will be bullish for equities as well. So keep an eye on HYG. It's a good thing to look at occasionally. People follow corporate credit because it's a good future indicator of market conditions, because smart money invests in corporate credit, so they usually know what's going on and can predict the future better than some retail traders like me. And the last most important macroeconomic ticker symbol is the VIX. If you follow the VIX, you know that when VIX is going down, SPY's going up, or vice versa. It's basically the put-call ratio. When everyone's short the market, VIX, the market will be going down, and VIX will be going up. And I've highlighted a long-term downward trending resistance. It looked like the price was breaking out of that. That's pretty bearish on the markets. Bullish for VIX, bearish for the markets, but it quickly returned to that resistance level for a retest. Let's see what's going on when we zoom in. Now here we are zoomed in on the daily candles, and you can see the VIX did break out. It came down to retest this dynamic support level. It was resistance. And I want to point out that the VIX price is near these high levels here, and historically within the past, well, since last February, we could call it, when the VIX reaches this level, it's a good time to go short on the VIX and long on the market. I'm not saying that the VIX could still continue to skyrocket or that it's going to crash down like it previously did at these high levels here. But if we get some good economic data about inflation, maybe some slowing economic growth, maybe the Fed might not have to increase interest rates, we'll see the VIX come down. That seems to be what's happening. The market has been very sensitive to economic data, so follow that. But conversely, if we get economic data pointing towards good economic growth, good strong jobs data, then we'll see the VIX go up and the market come down, in my opinion. That's how it's been going lately. And remember, interest rates still aren't at that 4.6% target like Fed and Jay Powell said. So that basically shows us that the Fed's still going to be increasing interest rates, and typically that has been bearish for markets, been great for the dollar. So keep an eye on all these macroeconomic indicators, these ticker symbols I mentioned, and keep an eye on the economic data pertaining to inflation, economic growth, jobs data, all that stuff. And I'll see y'all on the next